Now we're going to be here through lunch because, just kidding. How you guys doing this morning? You guys doing good? All right, all right. My name is Chad Riedlinger, Close With Us team, and a lot of you guys look familiar. And today, I've been asked to talk a little bit about some other mortgage programs that we have and I'm going to tie everything back into how you guys can use this all in your marketing. And then just to give a little bit of a preview for next month, you definitely do not want to miss next month's class. So we're going to be doing a class on organic social media and getting leads through organic social media. It's one of our best classes, and I highly suggest that you guys attend that. So it's really about how to generate more leads with your Facebook, Instagram, Twitter, YouTube, and LinkedIn without spending any money, which is always a good thing, right? And a lot of times it's more effective than even paying to get the advertising. So definitely want you guys to make sure that you make a note of next month. So today we're going to talk a little bit about mortgage programs you should know, and we have a nice small group today. So it'll give me an opportunity, because really what I want to do with these programs is have a lot of dialogue with you guys, answer the questions that you might have regarding the programs, because a lot of times there's a lot of misnomers amongst the realtor community about certain programs, and it'll give us an opportunity today to talk through those misnomers and also talk a little bit about how you guys can position this information to help you develop more leads and bring in more leads for your business. So let's see if this is going to work here. There we go. All right, so we're going to start with the basic FHA, right? So a lot of you guys have probably already heard of FHA loans, right? I think a lot of times they get a bad rep. I think a lot of times people think FHA loans are like the dumping ground for anybody who can't get a conventional loan, which is absolutely not the case. Just to give you guys a little bit of the details, obviously FHA is 3.5% down. We can go lower on the FICO scores. We actually can go as low as a 580 on the FICO for FHA. It also allows for a higher debt-to-income ratio, which allows buyers to be approved for a higher amount when they're out shopping. It also allows for a 6% seller contribution. If you guys are super good salesmen and saleswomen out there in this market, you can get them 6%, but we all know that's not really happening right now. You're lucky to even get your offer accepted. But just to let you guys know that it is a 6% seller paid credit is allowed, or a seller closing cost credit is allowed on FHA. And something that's interesting about FHA loans that most people don't know is they are assumable. Does anybody know what assumable means as far as a mortgage? What's that? Absolutely. Assumable with qualifying. So Joseph, what is that? What does that mean? Correct. Yeah, you're basically, so if let's say, this really hasn't been a big deal, but it may be going forward. And the reason why I wanted to bring it up to you guys is because this is a very important question to ask when you have a listing and you have a seller who has an FHA mortgage, because it could make the property much more marketable and get top dollar for it. I'll get it for you. No problem. So assumable basically means that the buyer of the property can take over the financing on the current loan. So why would that be important, say 2-3 years from now? Rates, right? Rates aren't going to stay real low forever. Imagine if rates, and they will be eventually, imagine rates are at 6-7%, and your buyer or your seller has an FHA loan at 3.5%. And somebody's looking to buy that property and get an FHA loan. Now they can assume that mortgage. Now they do have to qualify, as Joseph said. Like, it's not just, you just don't come in and take their mortgage over. They still have to credit qualify, but they can assume that the financing on that property. So it potentially could be a very big deal, because if the interest rate is significantly lower than the interest rate they would get if they went and got new financing, what's also going to be lower for that new buyer? The payment, right? So So now if you're selling a property and the payment on your property that you're selling for your seller is now half potentially of the payment if they went out and got a new mortgage, is that not something that you would want to market for that property? You know, so I want you guys to be at least cognizant to ask these questions, that when you have a seller, most agents don't even ask about the financing on the property. You wouldn't think to. So what I want you guys to do is just have a little light bulb that goes off in your head that allows you to think, hey, what kind of financing is on this property, right? And then you can always call us and we can help, help them through that process. But I want you guys to at least have the knowledge to be able to have that discussion. Absolutely. Yep. Correct. Correct. No, because a lot different mortgages have different allowables. So, like for example, on conventional, they're only able to do, let's say, 3% if the borrower is putting down. Let's say it's a 3% down conventional, they'd only be allowed to do a maximum of 3%. So it's not always going to be 6%. VA has different guidelines as well. So FHA allows the 6. Now you can, like on a conventional loan, if you're doing more than 10% down, then you can do the 6. If they put down, I believe it's more than 20 or 25%, they can actually go as high as 9 on a conventional loan. You're never really going to see that. And your credit and the closing cost credit can never exceed the closing costs for the borrower. So just keep that in mind as well. So if you're dealing with a higher priced property and you're looking at a $300,000 or $350,000 property, a lot of times that 6% will exceed the buyer's closing cost and prepaids. So they wouldn't be able to get the full amount. So at that point, they would have to then reduce the purchase price of the property. Yes, sir.
First, when getting sellers, number two, on the assumable mortgage, understanding the realities of advertising, mortgage brokers, and real estate brokers, what are we able to say about the finance?
So you would put, normally you'd want to put that in the remarks, and I would also put that in the broker's remarks, but you guys can say that seller of the property has a FHA assumable mortgage, and then I would just put a little disclaimer in there, credit qualifications do apply, or credit qualification required. So because it can be for anybody who can qualify for that FHA loan. So obviously if the buyer's coming and buying it as an investment property, that's not going to be an option for them to assume that FHA mortgage. But if they're coming to buy it as a primary residence and they qualify for an FHA loan, so I would just put a little blurb in there that credit qualification restrictions apply, so that you guys, because you guys don't want to obviously portray yourselves as the lender, but you want to draw to their attention. And if you put it in just in the broker remarks, then none of the buyers online will see that. So you want to make sure you have it in the property description or the remarks so that they can see that if they're searching for the properties online. Question?
What's the when you assume a mortgage? What's the cost?
Correct. So it's traditional closing costs.
The question is, it's going to completely become seller of your cost.
Correct. 100%. Yep. Have you guys seen like advertisements for like car leases, like Lease Trader, and where you could assume somebody's lease? So but you still have to credit qualify when you assume somebody's lease. So it's the same kind of thing for an FHA loan. You still have to credit qualify, but it does relieve the seller of all obligation because they are going to transfer that loan into the new buyer's name. Well, it's easier to qualify just from a debt to income ratio. It's going to be the same credit qualification, but as far as an affordability for that buyer, it'd be easier to qualify, and a lot more buyers would qualify because of the lower debt to income ratio that property is going to yield. Well, debt to income ratio. There's no income restrictions on FHA, but they would have to qualify for that debt to income ratio. The maximum on FHA is 56.99%. So they would have to qualify underneath that maximum debt ratio guideline. Question? It does not have to be a first-time buyer. It's a great question. So right, and we're going to actually that's what we're going to talk about now is some of the misconceptions of FHA. So the question was, does FHA have to be a first-time home buyer? And it does not. So you could essentially own a property That's like, let's say you own a property and you have a conventional loan on it, and you go and you rent that property out and you're going to go buy a primary residence, you can get an FHA loan on that. You even can have one FHA loan. Normally, you cannot have two FHA loans at the same time. However, there are extenuating circumstances. If you had, as an example, a duplex, and you bought that property and you've been living there for a year or 2 years, and you rented out the one side and living in the other, now you want to upgrade to a larger single-family property. Your family's growing, you got married, whatever the case may be. You can go and get another FHA loan. You rent out the other unit. Now you have that rental property. You can still keep the FHA financing on that property, and then go ahead and buy another property with FHA. The benefit, obviously, of FHA is the low down payment. So occupancy fraud is definitely a hot button when it comes to FHA, because a lot of investors or people that want to buy properties will position themselves as if they're going to live there as a primary residence. And I can tell you, underwriters are looking at that very closely to make sure that the buyer is going to be living and occupying the property within 60 days of closing. So it's not intended to be used for investment purposes, but it is not only for first-time home buyers. Also, let's say you were relocated because of a job and you were moving into a different area, that also would allow you to be able to get another FHA loan. Same thing with growing family, as long as you can document that you have additional dependents that are living with you and you're buying a larger property. It just has to make sense to the underwriter, and then FHA allows for those guidelines. What's that? Correct. But again, it's not like you can buy a house and then buy another house in the neighborhood and be like, oh, it's a nicer view or a nicer lot. Or, you could do that, still keep the FHA loan, but you'd have to go out and get a conventional loan and qualify. I don't know, because the mortgage is recorded. I'm not sure. I'm not quite sure of that, but that's why it's. Yeah. So that, I guess IMAP, if you guys use that for your MLS, right? So misnomers, and I wanted to talk to you guys about this. So how many here in this room have seen a listing that said no FHA financing allowed? Right, so everyone's kind of seen that. So what are reasons that you guys have seen or heard why FHA financing is not accepted on that property? Condo, okay.
You talk to the seller, the owner or the realtor, seller contracts fell through. They got tired of probably off the market twice. I don't know why.
Okay. What else? What else have you guys heard, or what else have you guys heard in the marketplace regarding why FHA would not be considered? Appraisals too scrutinous. What else? Because I hear a lot of them. I hear a lot of them from listing agents when I call. So I'm just curious if you guys hear these. Closing takes too long. These are all things that are legitimately said out in the marketplace, right? So some of them are legitimate, and some of them are not, and some of them are myths. So I want to debunk some of those for you guys, because I want you to be able to have a good conversation, an intellectual conversation with the listing agent, or have us reach out to the listing agent and have one for you regarding the financing specifically. So the first one that was mentioned is condo. That actually is legitimate concern. I'm going to give you a link in this presentation that I'll email out to you guys afterwards. Actually, I want to pass around a sign-in. I did not bring a sign-in sheet today, so I'm just going to pass around a piece of paper. But I want to send this out to you guys afterwards, and this has a link to the FHA-approved condos. It's like a needle in a haystack. So the likelihood, just if you put your just name and your email address on there, there's a copy of the presentation. So this has the link right here. You guys can look up the FHA-approved condos on there. Last time I looked, there was a total of 8 that were actively approved in Broward County. So the likelihood of you having your buyer find an approved condo in the building they happen to be looking in is like slim to none. However, if you want to go there and you want to look for specific properties that are FHA approved and see if any of those meet their needs and see if any listings are available, then that would be a good tool for you guys to check. All right. So approved or the property doesn't qualify for FHA. So why would some work and some not? Right. And how do you find that out? Or just a legal description. Right. So if the legal description says the word what? Is it right. So if it says condo in the legal description anywhere, right? So that's really where you're going to find it. So when you pull up, and make sure a lot of times when you go into the county records, it'll be like a short description. You got to make sure you click on the full legal description to make sure that condo's nowhere in there. If condo's nowhere in there, then you're good. Condo is anywhere in there, then it's condo. So you might walk up to a property and it might look and feel like a townhome. Might be multiple stories, have a garage, but if it's legally a condo, the fee simple. However they do that doesn't make a difference to us. But as far as the condo itself, legal description makes all the difference in the world. What? I don't. It's all to us. It's all just a matter of if it's in the legal description, it's condo. That's it. That's all they look at. They also do look at they will look at like a leasehold, something like that. So that is something that if the common areas are not owned by the development, if it's leased back, we will look at that also and kind of look deeper into that to see if it's going to be eligible. So that's rare. Like a lot of times you'll see like Kings Point or something like that, or Century Village if there's like a leasehold in there or a rec lease, stuff like that, we will look deeper into. But that does not automatically disqualify, but we have to look at that and make sure that it's going to pass. Here's something that's very important. Actually, I'll cover this in the next one. We talk about the low down payment conventional in regards to FHA. But so other things that people say is the appraisals are scrutinized too much, right? Or a lot of people just think FHA is or conventional is a dumping ground for all crappy properties, right? It's not the case. Right? I can promise you that 99% of the properties that have an issue with FHA are also going to have, an issue with conventional. If the property has any health or safety hazards or violations in it, you're going to have an issue regardless if it's conventional or FHA. FHA is not much more stringent than conventional. Like really, it's the same thing. I mean, I don't have any issues with FHA loans going through with repairs. They do have to say, like, for example, if there is an issue with the property, the appraiser will have to mention like what the cost of remedy is. So for example, if the property has a converted garage, but it wasn't converted with permits, then the appraiser just has to mention on the appraiser the cost of putting it back. They don't have to do it, but they have to put a cost in there of what it would cost to remedy. And usually they want to see less than $1,000. But normally stuff like that is just drywall and you just demo the drywall. So it's normally not because when they don't do it with permits, it's usually pretty simple to change back if you wanted to. So they just have to put the amount on there. If it's any health or safety hazards like exposed wiring or artificial skylights or broken tiles and stuff, you're going to have an issue on conventional as well. So I just don't want you guys to think that FHA is so much tougher. There's no inspections required. There used to be, where you had to give, like, this is way back with FHA, you had to give a copy of the home inspection. If that was the case, then obviously, yeah, we have a lot more issues because now the underwriter's looking at the inspection report and they're seeing all the stuff that the inspector found. It's their job to find stuff wrong, right? It doesn't mean the house is a bad house. It just means that they're doing their job, right? Covering their butts. So that is not a valid reason why FHA versus conventional, because you're going to have an issue both ways. If the property has mold or termites or anything like that, I mean, if the appraiser walks in and sees this stuff visibly, like they're not an inspector, they're not going in trying to find stuff wrong, but if it's visual, they're going to have an issue either way. If there's water, stains in the ceiling, either way you're going to have an issue because they're going to want to call for a roof inspection because the appraiser is not going to be liable for that, right? So all they're going to do is say, hey, you need a clear roof because they want to make sure there's no active leaks. You can have a stain on your ceiling, it's fine. It's just they want to make sure it's not still an active leak. Nobody sees the inspection. The only time they would see it, the only time a termite inspection is required is on what kind of loan? VA. So on a VA loan, you have to do a WDO inspection, which is the wood destroying organism inspection. So that is the one type of loan that you would have an issue on. But that's going to be an issue on either. Why wouldn't be an issue on one set of financing versus the other? Right, it could potentially be. A lot of times it's not. Yeah, it's right in this link right here. Yeah, so you're going to click on that. You're going to click the county, and it'll show you the approved. I have no clue. I have no idea. I don't look for the least expensive ones. It's not a good business model. So that's that's some of the things. Now the other thing is a lot of times the listing agents don't want to take it because if the appraisal comes in low, then the agent says what? It sticks with the property, right? So who knows the true rule behind that? So if you're getting an FHA loan and an appraisal comes in low and it's an FHA appraisal, what's the rule behind that? Does anybody know? It's 120 days, but so here's the thing: it only sticks with the property under two conditions. One is if the company that did the appraisal or the lender who did it actually logs in the appraisal. See, when you get an FHA loan, there's something called an FHA case number, and the FHA case number is assigned to the property address, not the buyer, or not the person, not the person. So when you get a contract, we open up an FHA case number. If that appraisal gets logged in against the property, then yes, it will stick with the property for 120 days. Now, there's one loophole to that though, and this is really where the listing agents can be steered in the direction that we want to be. Is if the next buyer comes in and gets a conventional loan, will that appraisal still stick with the property? No. Correct. So a lot of, and this is an important point to make, because a lot of the listing agents I don't want to take FHA because if I get a low appraisal, it sticks with the property. That's partly true. So if you're going to say, I don't want to take any FHA loans, why would you not at least take a shot on the first one? Right? Because you might have a ready, willing, and able buyer offering a higher amount, and they happen to be an FHA buyer. But yes, if the appraisal comes in low, then it will stick with the property, but not if the next buyer comes in and gets a VA loan or a conventional loan. It's only going to stick with it if the next buyer goes with an FHA. So if that first one comes in low, then say, I can't take an FHA financing because there's already a low appraisal on the property. Then you can change the listing. But why would you turn away half of the first-time home buyers that want to buy your property? That might be, because you got to think, half the financing we do is FHA for first-time home buyers. So you really, as a listing agent, want to turn away half of your potential buyers? Makes no sense. And the other rebuttal that kind of goes along with that for listing agents is they say the property value comes in less, or they're tougher on the appraisal than on the conventional. Why in the world would the appraise the property any different for an FHA loan versus a conventional loan? All they're doing is they're just giving the value of the property. Whether the buyer is getting an FHA or conventional or a VA, it doesn't change the value of the property. It makes no sense, but I hear it all the time. Joseph. It's as public as if the next buyer comes to get an FHA loan. It's tied to the FHA case number, but the buyers can't search that, and the realtors aren't going to search that. It's only going to be under when we go to order an appraisal. It's going to show in the system there's already an appraisal log. You 100% want to ask us to check for you, because I can go in and check and see if that appraisal was logged. Because a lot of times the realtors will just assume, hey, I got a low appraisal and now I can't go FHA. You got a 50-50 shot that the appraisal was never logged, because different people in each mortgage company saw, even if hey, a low appraisal, it might be the case, but it doesn't mean it was logged. So, so I want to talk a little bit about those. Here's the other one thing I wanted to point out to you guys. That actually is a benefit of FHA versus conventional if you're financing over 80%. All right. So FHA loans, if you put down less than 20% on a mortgage, what do you typically have to have on your loan? Right, mortgage insurance, PMI, right? So on FHA loans, the PMI comes with mortgage. It's automatically built into it. On a conventional loan, there's a separate insurance provider for mortgage insurance, okay? And that separate insurance provider is providing, and what they're actually doing is they are insuring anything over 80% loan to value, and they're basically taking on the risk. They're taking the risk off the lender and putting it on themselves. That's what the insurance is purchased for. And they're only insuring anything between 80% and 100%. So let's say somebody finances 97% loan to value. So they're going to be financing the difference between the 80% and the 97%, and that's what the MI is for, okay? Here's the thing I want you guys to understand, and this is why if I was a seller, knowing what I know from doing mortgages for 17 years and tell you how many buyers we've qualified. If I'm a seller and I'm selling property and I have a buyer on an FHA loan putting down 3.5%, and I have a buyer with a conventional loan putting down 5%, and they're offering me the same amount, I would feel safer going with the FHA than the conventional. And let me tell you why. The FHA only has one underwrite. The underwriter for that loan will underwrite the whole file, gets reviewed once, and you're done, okay? On a conventional loan, there's going to be two underwrites. So the underwriter for the mortgage is going to underwrite it, and then they're also going to send the file to the underwriter at the MI company. So if you are the MI company and you're insuring the high loan to value portion, right? If you're the underwriter, what are you gonna scrutinize the most in that file, knowing that you're on the hook for anything over 80% loan to value? What is your attention going to go to as an underwriter? What are you going to look at? The appraisal. They tear appraisals apart. So if you're a seller, how many sets of eyes, and you're a listing agent, and you're trying to do a good job for your seller, how many sets of eyeballs do you want on that appraisal? One or two? One, right? So I'm telling you, they look at the borrower very quickly on the MI companies, and they spend all their time on the comps and the appraisal. So if I'm a seller, I'm going to take the FHA because it's going to go through easier because of the appraisal. You're not going to have a second person and a second underwriter trying to scrutinize every single comp used and the adjustments made. We see it all the time. Right. And most people have no idea about that. So now if your buyer is conventional putting down 20% or more, it's irrelevant because you're not going to have mortgage insurance. Great question. So the question was, and this is for the people online, are the rates any different for FHA and conventional? That's a perfect question, and here's why. A lot of people, again, think FHA is just a dumping ground for people. FHA loan rates are traditionally better than conventional at high loan to values with credit scores less than 700 or 720. Conventional has a ton of pricing hits against the borrower for high loan to values and credit scores. FHA really doesn't have much at all. So whether you're a 620 FHA buyer or an 800 FHA buyer, your rate's going to be pretty much the same. If you're an 800 conventional buyer versus a 620 conventional buyer, your rate could be as much as like 1 to 1.5% different. Huge. Not to mention the mortgage insurance is set for FHA at 0.85%, whereas conventional can be anywhere from like say 0.5, 0.6% of the amount, all the way up to like 1.5 to 2.5 on the MI. So your mortgage insurance could be double and triple that of what FHA is. So at the end of the day, buyers care about two things when they're financing their property. They care about how much cash out of pocket and what's their payment. So when I show a buyer an FHA loan, I can get you a better interest rate and lower mortgage insurance, and their payment is substantially less than on a conventional. A lot of times they're going to pick the FHA. Now, the FHA mortgage insurance is for the life of the loan, unless they put down 10% or more. Most buyers are not putting down 10% or more on an FHA loan. But if they put down less than 10%, the mortgage insurance on an FHA loan is on there for life. And on conventional, they can get it taken off eventually once they have that equity built into the property. So that's an important thing to discuss as well. Question? Potentially. It could be. If you put down 10% or more on an FHA, it has to stay on there for a minimum of 11 years for FHA. Conventional, so they can remove it, but it has to be on there for 11 years. For conventional, they can remove it as soon as the property has 20% equity in the property. Correct. Right. On FHA? No. It used to be 5 years. So they used to say, no matter if it used to be, the mortgage insurance used to be much higher on a monthly basis on FHA. They reduced that. It used to be like 1.35%. Now it's down to 0.85. So it was a substantial reduction, about 0.5%. But when they made that change, they kept it on there for life. So it's a lot of times with FHA buyers, they're only keeping that loan for anywhere between 3.5 and 7 years anyway. So it's not. It's not making they're actually getting more relief having the lower MI. Because here's the thing. So what I usually show buyers is if your interest rate is 4% on FHA and your MI is 0.85, essentially your effective rate's 4.85. Just kind of the way it works out, right? So you're at 4.85% on an FHA, but if your interest rate is 5 on a conventional, I mean, you're better off with the FHA with the mortgage insurance than you are with the conventional. So those are the things that we show buyers, and we want to make sure it's the right product for them. But people just assume sometimes one or the other. We have to show them both options. Oh, go ahead. There's really not a minimum. There's not a guideline around it, but I can tell you the underwriter will scrutinize the next loan because of occupancy fraud. So they have to know that the intent was that they bought that to be their primary. Because if they only live for 60 days and all of a sudden now they're going to rent it out on the new loan, that's going to be an issue. Right. Yeah. So we always lock the rate. If the buyer chooses to lock, we always lock the rate through at least the contract closing date, and sometimes a little bit longer, depending on. So if it's the rate locks for 30 days, 45 days, and 60 days. So if it's a 34, 35-day contract, we'll usually lock it for 45. Sometimes, because we know how much it costs to extend the rate, We know the daily amount. So sometimes if it's like, say, 33 days for closing, we'll lock it for 30, get the buyer the better price, and then we'll just do 3 days of extension because it costs less for the buyer than doing the full 45 up front. So we're always trying to save the buyer any money anywhere we can. Yeah. She should be upset. That's retarded. I mean, like, why would you lock it for 30 when the contract's 45? But what? Yeah. But that'd be a question you'd ask your buyer. Hey, when are you closing? I mean, I don't. It costs, because they can always extend the lock. But it costs more to extend it than it does to just lock it that long up front. So like for the buyer to do a 15-day extension, it's going to cost them more than it would have for the add-on that would have been a 30 versus 45 up front. It's usually 0.02 points per day. I mean, it's whatever your loan amount is. It's a variable cost on how large your loan is. So like, let's say, for example, it's 0.2%. Let's say it's 0.2% for the week. So because they'll get discounts if they do longer extensions. So 0.2%, if it's a $200,000, you might look at $400. Yeah. I mean, if you say it's a buyer though, and they say 400, and they say that's all, they're going to flip out. So. It's usually not that much money to extend, but it's not. I mean, when you have that conversation with the buyer and it's $300, $400, $500, I mean, it matters to them. So if the loan officer's screwing up front, that's a problem. You don't want to do a longer closing. You want to do the closing as fast as possible, but like we'll usually extend it. Just again, we'll extend it right through the closing date. If it's, and we usually keep the rates extended for the customer if we need to. If it's not the customer's fault, we're typically not going to charge the buyer unless it's the buyer's fault. If it's the seller holding up, usually we'll extend it for them. Courtesy is like for us, that's good business. We tried in the past to get the seller to pay. You guys can go back to that, and we like that. I mean, it's not really a fault either, so we don't like paying for it. But just from a customer service perspective, we don't want the buyers to have to eat that if the seller's, delaying it for whatever reason. We try to do it within reason. Now, if it starts going a long time, I mean, that becomes where someone's going to have to pay a portion. Because if it becomes an issue of like there's no more profitability in the loan to continue to pay, I'm not going to cover that if it's our issue where we for some reason delayed it, we absolutely pay every time. So if you close in July, it's September 1st, typically. If you close within the first 5 days of the month, you have a choice to either have it be that first of the month coming up or 55 days from then. So as an example, if you're closing on August 5th, you have the option to have your first payment due either September 1st or October 1st. If you have it September 1st, you're going to have 5 days of credit of interest, so a credit towards your cost at closing. If it's not until October 1st, then you're going to have to pay 25 days of prepaid interest at closing. So it's either a 5-day credit of interest or 25 days of cost on interest. And the reason for this is that the interest on a mortgage is paid in arrears. So it's the opposite of rent. So you live there first and then you pay. So as an example, when you're paying your October 1st payment, you're paying for September's interest. So when you close on a mortgage, when you're closing, say, August 5th, and you don't have a payment till September, so when you make your September 1st payment, you're paying for October 1st. When you make your October 1st payment, you're paying for all of September's interest, right? So but you still have to pay for those 25 days of interest for August that you live there. So the buyer always pays the interest up front for the rest of that current month while they're when they're closing. Because when they make their first payment, it's only going to be for the prior 30 days. Does that make sense? Correct. Because then they potentially wouldn't have a payment for 60 days, but they're going to have to come up with more money at closing because they're going to have to come up with 30 days of interest at closing for that month ahead of time. So it's like one half dozen of the other. They're going to pay it up front and have 60 days to the first payment, or they can pay less out of pocket and they have their first payment come up in 30 days. So we had that discussion with the buyer, depending on their cash to close scenario. If they have enough money and they don't mind paying and they want to have that full 60 days, then we'll do it that way. We always have that discussion. Do you want to do an interest credit, or do you want to have your payment, be longer out? They're going to pay the same amount of interest. There's no way. They're not getting off easier either way. I mean, they're going to pay the interest for every day they live in the home. So there's really no, it's, robbing Peter to pay Paul. It's the same scenario. Any other questions? 60. Yes. Yeah, you have to move into the property as a buyer within 60 days of the closing. So this is like super small because you guys are far back. I did make it. Yeah, you guys aren't going to be able to see that. So I'm going to talk through it with you guys. This is going on conventional loans now. So this is talking about low down payment options for conventional. And on the left-hand side here, that says Fannie Mae Home Ready. On the right-hand side, it says Freddie Mac Home Possible Advantage. These are both 3% down conventional loans. Okay, so I wanted to just discuss this with you guys briefly to let you know that there are options other than FHA for a low down payment option for conventional. These do not have to be for first-time home buyers either. However, for both of these programs, there's income restrictions on the program. I'm going to give you guys on the next page here. Oops. Go back. All right. So you're going to have the links. It's going a little funky on me now. Anyway, you're going to have the links for the both programs. So you guys, restrictions are for conventional loans on Fannie Mae and Freddie Mac. So and it's different. It's per property. It's per the address. So when you click on either one of these links and you put the address of the property in, it'll tell you what the income restriction is, if there is one, because some properties are located in areas where there is no income restriction, which means that any buyer coming to that property who's buying it as a primary residence can qualify to buy that property. So usually every time a buyer comes to us with a contract and they're going conventional, we always look up the property to see if it's eligible, because the pricing on these loans can be significantly better than the pricing on a traditional 3% down conventional. Because remember I told you guys before that on a conventional loan, the interest rates can be very heavily weighted based on the credit score and loan to value, very heavily. Talking like 2 to 3 points of hits against the buyer on their pricing. These programs cap the price hits at 1.5% for the buyer, which means that this can be a very competitive option for them, and can yield interest rates at anywhere between 0.5% to 1% lower than another 3% down conventional loan. Bless you. So let's say, for example, we're in competition with down conventional, and a lot of lenders don't even know about these or don't look these up. So every single time we'll look them up. If they're eligible, we put them in and we crush the other lender, because they're a lot of times they're not paying attention to Home Ready and Home Possible. So this caps the pricing add-ons, so the rate's lower. It also caps the mortgage insurance premium for that buyer. So they're not only saving money on the rate, which is lowering their payment, but they're also saving money on the mortgage insurance, which is lowering their payment even further. So these are two very, very good options. So the other things I want to talk to you about, I'm not going to cover all these for you, but I want to just talk about a few things here. That's super blurry. I don't know why. Yeah, and it's small too. I mean, there's like so much I wanted to put on there for you guys, but I guess I'll fix this slide and put it on too. When I send it to you, you guys will be able to read it perfectly fine. But occupancy, both are primary residence. Number of units, it's one on both of these programs, so you can't buy any multifamily with these. Let's see, and home buyer education is required on the properties. They have to do like an online course to qualify for this. It's $75 for the course for the Fannie Mae program. Now, if a home buyer happens to be a prior homeowner, then they're excluded from doing that on the Freddie Mac version. But when I show the buyers, they're going to save money on their interest rate and their mortgage insurance, but they have to go online and do a $75. They don't care. They do it every single time because they're going to save money each month, for the life of their mortgage. Yes, and that's one of the big things I wanted to discuss with you guys is that if a buyer wants to get into a condo but has limited down payment, this is a fantastic option because they can finance condos with this. All right. So the only thing I want to bring to your attention though is that when you finance condos, how many in here have helped a buyer buy a condo that had to get financing? All right. So the issue is that when a buyer buys a condo, there's two approvals happening simultaneously, right? So there's the approval of the buyer's financing and there's the approval of the condo. So the buyer might be a slam dunk, but the condo might not, right? And that's where lies the problem with financing condos. I would strongly encourage you guys to make sure that obviously if you're using us, awesome for the financing, but if you're not, if you're doing a condo, make sure they're doing the condo approval up front. Most lenders are not. And most lenders, you're not finding out until 2 or 3 weeks into the process that you have an issue with your file. And now 2 and 3 weeks into the process, your buyer's already paid for the appraisal. They've already paid for the inspection. So now they're out a whole heck of a lot more money, right? So a lot of times your buyer who's already coming in with a limited down payment, for them to be missing out on another $800 or $900 because they paid for an appraisal, they paid for an inspection, and they went and paid for a condo review, because they're going to have to pay the condo association also for the review. So you're talking about $1,000 now out of pocket. How many times do you think your buyer wants to do that? Not a lot, because they're going to use all their money up. They're not going to have money for down payment anymore. No. So we do it up front. So when we have a condo, the first thing we do is we do the condo review. And we usually talk our realtors through, if I know we have buyers that are going and putting offers on condos, I will talk to their realtor who's representing them to say, I would encourage you to try to put a longer inspection time frame in the contract and a longer appraisal time frame in your contract. It doesn't have to be like ridiculously long, but if it's like 10 days or 15 days, that would. And sometimes I even would explain to the listing agent why. You're not trying to delay the inspection or the appraisal, but if you can just talk to them as a human being and say, look, the biggest part of this process is for financing, and we want to get that done up front before the buyer parts ways with another $800 between the inspection and the appraisal. A lot of times the listing agent will understand. 10 days should be plenty, as long as the buyer does their job up front and we submit the information to the condo association. We're going to have to get the condo association to fill out a full condo review form, as well as provide us with all the financials, the budgets, the reserve, all that stuff. They do. Yep. But I'd rather the buyer pay just that, and like let's say $200 or $250, pay that up front, and potentially they'll be out $250 if the condo doesn't check out, but that's a lot better than $1,000 after they pay for the appraisal and inspection as well. And who wants to wait like 3 weeks to find out if you actually have a solid deal, right? So we would rather find out up front. So that's why we do the condo review up front. That's the first thing we do. A lot of lenders are just they don't care. They'll do it once it gets to the processor and processing, and then it's not their money. so that there's no, we just try to make sure we do the right thing for the customer and the realtors. Trying to think if there's anything else. What other questions do you have? Now I talked a lot about the perks of FHA. The perks of conventional, obviously, is that listing agents seem to like it better just because they have these, again, they have whatever has been told to them by other people via telephone. They just think that's legit. And because the mortgage insurance does not have to stay on the loan. So that's a big perk for them as well, because they can apply once they have 20% equity to have that MI removed and their payment will drop. So a lot of times the customers like that. Right.
We have a realtor, right? Realtor, mortgage company, they're already appraisal after 20, probably.
It's a conventional loan. Well, FHA, I mean, they can switch as little as like 10 days away, because we're not going to do another appraisal. I mean, it depends on how long your time frame is. I mean, if I'm a buyer, it depends on how good of a deal did I get. All right, did I get a good deal on the mortgage? I mean, they give me a very good rate. I mean, if I'm going to save, I mean, you're talking, and they can be in that. I mean, it depends on the buyer too. I mean, how long you be in the property for? So if they think they're going to be in this property for a while and they're going to get a lower interest rate going to somebody else, I would not. I mean, how long until the closing? Because that's really the important. That's plenty of time. 3 weeks is plenty of time. Yeah. Right. And did they get the tax credit? That's another thing we're going to talk about in a second. So there's definitely, it doesn't hurt for them to get another quote, because if they're going to save 50, 75, $100 a month, it's a lot of money. I mean, you times that times 60 months for 5 years, and that's a substantial savings. And the process will go very quick, because we're just going to transfer over the appraisal, so you don't have to worry that the appraisal is going to come in low or delay anything, or mess up the financing. So, I mean, they should call now. I mean, why would they wait even longer? I mean, if they only have 3 weeks left, like, what's that? That has nothing. I mean, right, but if they can go out and get a lower rate now and get it locked throughout the closing date, like the rate lock expiration is a small factor, because they're going to have to pay, a certain dollar amount. That's a one-time amount to keep it locked. But if they're going to pay a higher rate for the life of the loan, that's a bigger issue. So I wouldn't wait I wouldn't wait any longer. I would just say, hey, what's your rate now? And if that's substantially less and worth, changing, I mean, 3 weeks is, I get contracts when realtors are telling me I got to close in 2. So to have 3 and to know the buyer's already, have all the paperwork together and already has an appraisal, that's like an easy one. No, they pay nothing to them. They already paid for the appraisal. It's going to come over. It comes, no, because the customer pays up front for the appraisal. I don't know, worst case scenario, they have to pay for their appraisal when they transfer it. The company might say, in order for us to release it, you have to pay whatever that was paid to the appraiser, because the money doesn't go to the company for the appraisals, it goes to the vendor. So worst case scenario, they're going to have to pay for that, and we'll figure out with them. We'll say, look, yes, you have to pay that $450 for the appraisal. You're going to save $75 a month. Your break-even point's 5 months or 6 months or whatever the math works out to. So yes, these extra costs. A lot of times what I'll do to make it very easy for the buyer is I'll say, here's your rate. It's a lower rate. I'll just give you a $500 lender credit from us, because that way, yes, you're going to have to pay it, but I'll give you the $500 at closing to offset that cost. It makes the buyer feel better mentally. Our job is to remove obstacles mentally for buyers. It might be a little thing, but to us, to make it easy for them to say, hey, we're just going to give you a credit for whatever the cost of the appraisal is. That way you don't have to feel like you're missing anything. It's like, it's like for a realtor. I mean, if you guys are making a $6,000 commission and your deal depends on $400 credit, I mean, you make a business decision, right? So that's what we do every day. I mean, it's just, We'd rather do a loan than not do a loan. That's like, right. Yep. Oh, check them all off? I mean, I would check off the one that they're doing. I mean, I would just check off the one they're doing. Well, your buyers are already pre-approved on it. I mean, if you don't know, you can check them all off. But I mean, usually when your buyer is working with you and putting offers on properties, I would hope you would know at the time they're putting offers in what kind of financing they're getting. I mean, that's like, you can, I mean, as long as the listing agent takes it, you can check them all off. I mean, whatever. I don't care. I mean, for us, the lender, we don't care. Sure. So usually we're going to have to repull the credit, and the credit inquiry, depending on when he pulled it last, potentially could ding him again. I think it's 30 days for shopping. Yeah. Now the credit inquiry, the effect of the credit inquiry on their credit will fall off after 90 days, from what I'm told from credit agencies. So like that impact will take after 90 days will go away. I mean, the credit agencies know you have to run credit from time to time. Now they will give you a 30-day window to pull it multiple times to shop, like for a car loan or a mortgage. So they know you're going to shop, and so you might have to pull your credit multiple times. On your credit report, it will still show as multiple inquiries, but the impact on the score will only be once within 30 days. But I mean, here's my thing, and this is what I tell buyers. It's a credit inquiry. Like, it's not real dollars. It's your score for like a short period of time. Your score goes up and down every day. Every day. You go shopping at Target and you put it on your credit card, your score is going to drop because your balances on your credit card change. It doesn't mean that your score is going to stay low. You make your payment, you pay your credit card, and your score goes back up again. So, like, if I'm a buyer and I'm contemplating getting a better deal on a mortgage and saving real dollars in my pocket, like, why do I care if they pull my credit one more time? The purpose of having good credit is to save money. So why would you not take if you can save money and just all it costs you is a credit inquiry, which is going to, like, after 90 days go right back to where it was anyway. Like, I never really understood that. I can just, from doing mortgages for 17 years, typically, and this isn't like when somebody's already approved somewhere, so I want to take that out of the equation. If they're already approved with their bank or whatever, but typically when a buyer comes to us and doesn't want us to pull their credit, is a reason why. My buddy approved me over at my mortgage company. They're so afraid to hear the no that they won't let us pull, but 9 out of 10 times there's a reason. And just because their buddy said yes, I can actually approve a loan. What's that? The underwriter, right? As much as we like to think we're really good and we're loan officers, and I've been doing this for 15 or 20 or 30 or 50 years, we can't approve loans. Only the underwriter can approve the loan. So I see people operate out of fear, and they don't want anybody else to do it because they don't want to hear no. They're just so happy they were told yes by somebody, even if it's not a legitimate yes. And we see it all the time. If people are unwilling to share their information, usually it's because they're hiding something, or they think they're going to get around something, or the underwriter is not going to see it. They see it. Question. Right. Right. That's a great question. And that's actually going to become even more relevant coming up in the second half of the year. And so for people online, because I guess Jonathan said to say the question again so they could hear. So the question is, what's the difference between a pre-qualification, a pre-approval, and an approval? It's actually three different things. And the new contracts actually address this. So a pre-qualification is a lender just giving a letter based on usually verbal information given, or their best guess. They may run the credit, they may run DU, whatever it may be. That ultimately is going to be called a pre-qualification going forward. A pre-approval is where an underwriter physically reviews and approves that buyer and their loan prior to going shopping for a home. Okay, so you can see the difference there. Pre-qualification is a loan officer's best guess. A pre-approval is an underwriter physically approved their credit, income, and assets. And a state now going forward is when the loan with the property is approved by underwriting. So I'm glad that you said what you said, because it's a very valid point that the banks typically will not issue a pre-approval. So I think we've talked about this a few times, and I may even have it in this presentation. We have a program called Almost Home that we send all of our buyers through. So we underwrite all of our pre-qualifications up front. So this is a good segue into that, and that's important for so many reasons. But you know that you're working with a qualified buyer, right? So you're not showing properties, driving them all around town, and like I respect what you guys do more than anything, because the amount of time you spend with these people, geez, like it's a lot. Last thing you want to do is spend it with somebody who, you spend 6 months with somebody who was never really pre-qualified in the first place or pre-approved in the first place. Just like there's a lot of realtors that are newer to the business or don't know what they're doing, there's a heck of a lot of loan officers that don't know what the hell they're doing. They just don't. They ask half the questions, they're rushing through, they don't want to be bothered, whatever the reason is, and they give a pre-qualification because, hey, it's not their time. They're not wasting their time. Like literally banks give, I had one, so I have an investor, this is a great example. I have an investor that makes every property he buys and sells and flips, he makes the buyers come through us to get pre-qualified or pre-approved prior to accepting the offer. Now they don't have to use us, but he won't take the property off the market unless he knows that buyer is solid. So the buyer comes to us with a pre-qualification letter. I'm not going to name the bank, but their logo is green. So they come to us and they have a letter, and we're like, well, we can't use that. We have to pull everything. So I pull up their credit, and the guy had like a 530 credit score. I was like, how the heck did you get a pre-qualification letter from this bank? A 530 score. So I'm going through his credit report. There's not even a credit inquiry. And so I asked the customer, I'm like, so, like, how did, like, you got a letter? Like, he's like, oh, they did a verbal. I'm like, a verbal credit pull? They asked me how my credit was. I told them it was good. It was like, I swear, I'm like, so I'm reading the bottom of their pre-approval, and it's like, it says in the bottom of their pre-qualification letter, it's based on the verbal, whatever their verbiage was from the customer. I'm like, geez. And so I have a buddy of mine that works at the bank, and it wasn't the guy who gave the thing, but I called him. I'm like, they're like, yeah, that's just what we're told to do, because the cost of pulling all these credit inquiries, the bank's absorbing. They don't want to do it. They don't want to absorb the bank probably has a ridiculous deal cut with these credit people. They're probably paying like $2-3 a credit pull, but they don't want to spend the money on a credit pull because they might not get the loan. So they're sending people out with these letters of pre-qualification based on a verbal verification of credit. I'm like, I wish I could do loans based on a verbal verification of credit. Everybody would get a loan. Yeah. Buyers, as much as they don't want to hear no, they're so much better off hearing no up front and put them on a roadmap than to get their hopes up, find their dream home, put a contract in, and put a deposit down, and now be let down. Anyway. So I just wanted to let you guys, it's like stuff's really happening out there. And so most banks, they don't even want to spend the money on a credit report, let alone spend the money on an underwriter reviewing a pre-qualification or a pre-approval on a deal they might never get. How much money it costs for an underwriter to review a file? They only have so much capacity. right? They can only review so many files a day. It's like any of us, right? We can only do so much in a day. And underwriters typically are either very close to or exceeding six-figure salaries. So when a company like our company, Hamilton Group Funding, pays to have extra underwriters so that we can underwrite all of our pre-approvals that might never close with us, that's a significant investment financially in doing things the right way. So we underwrite all of our pre-approvals up front. So not only do you have a better experience, the buyer has a better experience, but also when you go to put offers on your properties, you need to let the listing agent know, because we're going to give you guys an approval, like a full approval, clear of all conditions other than property-related conditions. So you're going to have to get an appraisal, you're going to have to get title work done, and insurance, and you're done. Buyer's done. So when I say like 15-day closes, no problem. Because they're done. The buyer's done. They literally have to get appraisal, insurance, and title. So we call the most important part of this whole process is letting the listing agent know what your buyer has. Because most listing agents are just, all they're really looking at is the first page of the contract and trying to see what your offer is and when you're closing, right? So when you can put on there closing in 15 days and a loan commitment in 3 days, that's probably going to get their attention, right? Because you're only looking at the first page anyway. So now you're positioning yourself like cash, closing in 15 days. I mean, even if you're a cash buyer, you want to look at the title, right? You're still going to make sure you're not buying somebody else's problem. But we want to draw their attention that this buyer's already been fully approved by underwriting, and you're going to have a copy of the approval letter you can provide to them, signed by the underwriter. We reviewed everything, all their assets, income, and credit. So that is a big deal in this market to get your offer accepted, because you guys know how competitive it is, right? It's hard to get full underwriting approval. We can do this in 15 days. Usually they're going to say my seller can't close that fast, and you're fine anyway. But it helps a lot to let them know that your buyer is solid. And then we would even encourage you guys to get us on the phone with them to make sure that listing agent understands exactly what they're getting. There's no risk other than the property-related stuff falling apart, which it's not our buyers. Our buyer, no buyer can fix that issue. If they're asking for too much, it's not going to appraise, or there's an issue with title or something like that. I mean, they're going to have that problem regardless of who the buyer is. Question. I'm sorry. Repeat that question. Right. Are they really already pre-approved or pre-qualified? Okay. Yeah. Yeah. I will never, and people can have an issue with it all they want, but I will never issue even a pre-qualification without reviewing all their income, assets, and credit. Never. There's a reason why our reviews online are so good, because I'm just not going to do it. I would rather that customer be pissed or that realtor be pissed because I won't give them a generic pre-qualification letter than jeopardize my team's patient. I don't care. That one deal is not worth it. Right. But you'd be surprised. Realtor's like, just give me a letter. For the offer. I'm like, I'm not just going to give you a letter. Go to Quicken. Go online. You can print your own in 10 minutes. Yeah, exactly. Print your own letter, and you see how the file goes after that. Yeah. We'll provide it whenever they want it. So typically we'll provide it up front, even on the pre-qual with no property. We give them estimates, and then we'll also give it to them prior to them submitting an offer. We'll give them the exact breakdown of their cash to close and their payment. Yeah, absolutely. As long as the buyer, cool with it, which they know they are. They trust you more than they trust us. So they're sending you anything that we send them, but we check with them first. No, don't do that, because that's going to give you way off numbers, because a lot of the costs are fixed. So if you're doing a low loan amount, it's going to skew it. And if you're doing a higher loan amount, it's going to skew the numbers way down. So like I've had people before that say, oh, 3% or 5% rule of thumb, and it ends up way off. So let us do it. And the other thing that we do that most companies do that's seen this is that we will not give a generic pre-qualification letter because we pre-approve everybody to a payment, not a loan amount or a purchase price, because you can't pre-approve somebody to a loan amount or a purchase price. All that matters is ratio, and the debt ratio isn't based on a loan amount, based on a payment. So we need to make sure that the buyer's maximum payment is wherever it is, and the payment on the property is less than that maximum payment. So when you guys see buyers walking around with a generic, pre-approval letter for $250, be scared, right? Because you guys know that when you look at properties for $250,000 there, they're all different payments on those properties. I guarantee you give me five, go on the MLS right now and pull up a property for $250, pull up 5 properties, and they're all going to have vastly different payments. So how, as a buyer, can I legitimately put an offer on all 5 of those properties and think that my financing is going to be secure? What if one of those properties is a condo with a $450 a month HOA due? That's going to blow the debt ratio potentially right out of the water, right? We've had ones close enough where if the property being in a flood zone or not could blow the debt ratio out of the water. That extra 40 or 50 bucks a month makes a difference in their debt ratio. So we give buyers a pre-approval calculator that shows them their amount of payment they're qualified for, and then it gives them a range of what they can qualify for. And then every single time they want to put an offer, we do a specific pre-approval letter for that property, because we're going to look up the MLS listing. We're going to see if the property is a condo. We're going to see if the property is a flip. We're going to see if the property's been in a flood zone. So it takes us like, but it could save you a hurt later, because we do our homework with the taxes, because the buyer has to qualify based on what the taxes are today, not going to be a year from now. We'll educate them that your taxes are going to be X a year from now, because I don't want them to get payment shock later when those taxes double. They need to know that up front. I'm not going to sell them. Happens, right? If you don't educate them correctly. But the issue is I have to qualify them, and the underwriter going to qualify them on what the taxes are today. So I can't just use generic numbers. I have to use real numbers. So all these buyers generic pre-qualification letters, and you guys are putting offers on 10 different properties. How does that work? Right? That's an issue. Well, I realize that's an issue. That's an issue.
We need to know where that price line so that the seller's time or our time, let's say you're 100, ballpark, what is that?
We'll give the buyer the price range based on the property type they're looking at, because the 1,500 looking for a single family home is going to yield a different price range than 1,500 looking for a condo. So typically a $1,500 single family, I mean, we're looking at somewhere like 175, 180, 190. Can depend. But we give them a range, and that's why we do specific pre-approval letters for every property, because we don't know for sure. We'll give a range on the spreadsheet we give them. We give them a range, but you got to come to us with each property you want to put an offer on. Now, within the next 2 weeks, we actually have a software coming out that we're going to share with you guys, where all of your buyers that you send to us that are pre-approved are going to be loaded in the back end of this website that you guys can log into, and it will give you all your buyers. It gives you your pipeline, and it tells you their maximum payment they're qualified for. All you have to do is click on that buyer, put in the purchase price, the taxes, and the HOA dues, and it will automatically tell you if they qualify or not, and will let you print your pre-approval letter on demand, because it's tied directly into that buyer's approval. So we give the max payment, we give the loan type that they're doing, and so all you guys have to do is plug in the information from the property. And then, so if it's over the payment, it won't let you do it. You have to reach out to us, because a lot of times there's stuff we can do to still make it work. Like we can mess with the rate, or we can have the buyer pay down, or we can do whatever. But we just want you guys to understand that you'll be able to print them on demand. And a lot of you guys come to us and say, I want an offer, we're going to offer 206. So we do a letter for 206, and then like an hour later, you're like 207, 208, 209. We love you guys. It's like, So now you guys will be able to do it on your own. You'll be able to put in your own prices, print your own letters. So as you're on your computer doing your offer, typing up your offer, you just log into, we'll give you a login, you type in, and you can create a approval letter and have it right there, or download it right to your computer.
Are you finding it more buyers are, it's hard to find homes like
Right.
so can't do a second.
They can on conventional. But they're still going to be limited on the loan to value. So we talked a little bit about the condos before, for example. So let's say a condo doesn't get approved. Let's say your buyer's putting down 5% or 10% and the condo doesn't get approved. A lot of times we'll do a first mortgage and a second mortgage together at the purchase. And we'll do a 75% first mortgage. And then we'll do like a 15% second mortgage. So they're still getting 90% financing, but they're still getting the limited review. As long as the first mortgage loan is 75% on a primary residence, then they don't have to do any condo review at all. It's a limited review. It's like 8 questions. My team calls the association, asks those questions verbally over the phone, and they're done. And almost every single condo will fly right through. 75% loan to value on the first, but a lot of times we'll do a second mortgage right there, and they can take that second mortgage usually up to 90% and still be able to get that condo financing done. Well, that's going to be up to the condo because now, so the question was if the condo requires 20% down. I've had different condos look at that different ways because they're going to see the first mortgage is only 75%, but potentially they can also know that there's a second mortgage on there. So that'll be up to the condo to decide if they're going to allow that buyer to. Yeah, you guys. I mean, usually the agent will call the association and have that conversation. You don't want to hide anything. You don't want to get to closing and then all of a sudden then there's a second mortgage and now all of a sudden your deal's blowing up because the HOA is saying no. And agents, I would just tell you guys, please check on that stuff up front. I've had 2 deals in the past 3 months die because the HOA had a minimum contribution either from the buyer or a minimum down payment requirement, and the listing agent and the buyer's agent, neither one of them knew or said anything. I don't blame the buyer's agent for it because it's not anywhere. I mean, it should really be in the listing. It should be the listing agent, but just I would make sure you check. Yeah, correct. No, it's always in writing. The ones that we've seen, it's in writing, but the listing agent doesn't put it in the listing. So we would have no idea. So we're going through the whole process, and now we find out that then the buyer needs one was an issue of they required to have a certain loan to value. The other was an issue the buyer was required to have a certain amount of money out of pocket. Like it was like they needed reserves, actually. The second issue was they needed to have like 6 months of association dues in reserve in their bank after closing. This buyer didn't. So they ended up with a problem. So no, we tried every which way to it was that? FHA does not require reserves. Nope. It's whatever the automated underwriting. So when we run the loan through the automated system, the DU it's called, it tells us whether or not the buyer needs reserves. Most of the time it doesn't. There's no reserves required. They may need reserves if it's a 600 credit score or 580 credit score and they have credit issues, and DU say you need a 1 month requirement. And buyers take full advantage of that. I mean, they're literally like, I don't even know how they pay for a moving truck. Yep. Correct. As long as the lender needs to. I mean, I'm going to sit up here and tell you the lender needs to know. Has it happened before where we don't know and it happens on the side? Absolutely. If it's okay for the seller to do that? The seller to hold a second mortgage? No, the lender's okay with it. They're okay, depending on the program. Normally it's okay to have a second mortgage, whether it's from the seller, but it has to be disclosed. So, and we have to say, what's the payment going to be associated with that? It has to factor in the debt ratio. So it has to be, above board. You got to make sure you disclose that. FHA normally, no, there's no second. Yep. It's not going to be your last question. That's okay, though. That's okay. I like all the questions because if you're thinking it, somebody else is probably thinking the same thing. Meaning, yeah, I mean, I don't really have so we have different services that we subscribe to that we can put our agents on that will give you like listing, it will give you like marketing collateral. So like when you do a listing, it'll give you like open house flyers and financing flyers, and it'll give you an infograph on the school demographics for that property, and it'll also give you an infograph on things to do in that neighborhood, like the different things that are surrounding that property. So that's all good part of the marketing stuff. I don't have. If you guys want to subscribe, I used to have a membership to this, but I canceled it for now. But if you guys want to look it up, it's called Agent Marketing. They have a fantastic listing presentation that you guys can use as an agent, which I would highly suggest. I think it's like $99 a month, but it's called Agent Marketing. It's a phenomenal system. So you can put in the information on the property, you can put in the photos of the property. So even before you get the listing, and I used to teach this, and I can actually do this class again for you guys. You can go on and create a marketing strategy for that property. So you can go around before you go to the listing presentation, snap a few photos of the property, of the area, the community. You don't have the inside photos possibly, but you'll have the outside photos, and you can build a listing presentation with their property highlighted. It's much more impressive for you guys to do that and put the legwork in than to give them a generic pre-done canned presentation, because it shows that you put in the work. There's also, I can send you guys as part of the email, I actually did a training called a flower pot strategy. I don't want to get too far off base, but I will tell you real fast what it is. It's used together with this agent marketing platform. I did a 2-part training. It's on YouTube, and I'll send you guys the links. So Keller Williams was actually teaching. It's a killer strategy. So you guys can go on let's say you're targeting expired listings or FSBOs. And so now you can go online, you can get all the photos of the property, right? So if it's an expired listing, you can get all the photos on the MLS or on anywhere, right? Zillow or wherever that property was shown. Same thing for sale by owner, right? You guys can go and get all the stuff for sale by owner. It's all there online. So you get all the information, you build the listing presentation, and then you can go after those expireds. That's just one question. This is getting a little off topic, but I just want you guys to be aware of this. And this is stuff I help our agents do. If you've ever talked to a seller whose listing or property didn't sell, what's the number one reason why they tell you the property didn't sell? Coming from a seller, what do you think the seller's perception of why their property didn't sell? What's that? Blaming the realtor, right? That's it. I said the number one, you guys all kind of in unison said the same thing. So what's the real reason? Price or it's usually not the marketing so much, but I'll tell you, it could be the marketing, depending on the agent. But it's usually price and condition, normally, is why it doesn't sell. So when you go out to an expired and you're talking to an expired, they already are blaming their realtor, right? You got to use that, right? You know that they're blaming their realtor. In their mind, their realtor sucked and their realtor didn't market the property effectively. Okay, and they might not have. They might have done a crappy job. So when you go and use this agent marketing system, and so envision this, you're building a flower pot, and you have all this marketing material, and you use it to build the flower. And I'll send you guys examples of ones that we've done. So this system, when you put in all the information on the property and the pictures and everything, it prints out all these different flyers and PowerPoint, all these different presentations, and you deliver it to their house. So you want to farm a specific area for this. You want to find all your spots in this agent marketing system, and it prints everything out for you. So you go and you deliver this flower pot, and with a little handwritten note in there, and your real property didn't sell. I'm a marketing genius. I'm a marketing guru. I just want to give you a little example of the stuff I do, right? And it's all the different single property websites. It'll highlight all the different stuff you do in here, and you deliver it to them, and then you leave. I just want you, because what's going to happen is it's not like generic done for them on their property, and in their mind, they already thought their realtor did a lousy job marketing. You're positioning yourself that you're going to market the property more effectively, so that when you follow them to later, and they haven't a chance to absorb all the information in there, you're already giving yourself a leg up on the competition. And a lot of realtors will even leave it at their doorstep if they're not home, because they leave like their card. And the realtors have told me that they go to do the listing presentation in the home, and the flower pots are still sitting in there because it's their property stuff. They don't want to throw it away. You know, if you give them generic flyers with generic houses, they wouldn't care. But this is all their stuff. It's their home. So I have a whole presentation that I'll send to you guys. But I highly suggest, I mean, you guys can kill it with expired listings. Just understanding the psychology of that buyer and why it didn't sell. Now, you have to have a conversation regarding price, because 9 out of 10 times it was the price. And you have to, and I know that you can, like, in the MLS, you guys can print like these reports of like what the property value actually is, and do, you know, CMAs and different stuff like that. So a lot of times the sellers, they'll say, look, we'll do it your way for this long, but if you're going to list a property with me, we're going to agree up front that we'll do it your way for whatever predetermined amount of time that you guys agree, and then we're going to do it my way. Because don't go on property again over value and expect it to sell for you and it didn't sell for somebody else. I mean, I know right now they're selling for over market value. I get that part, but have a conversation up front. Don't hate it and get them to buy in up front. Look, we'll list it for every month, but if it doesn't, if you're not getting you're not getting a contract in the first 15 days, then we're going to do it my way. Just my little piece of advice. I'm not a realtor, but I've done this long enough to know what works, and I've masterminded with a bunch of top agents that these strategies, and they won't take a listing if it's overpriced. Why waste your time? You're going to spend money marketing that property and going and don't waste it with the seller either. Question. How many flower pots did they get? That's why you give them a flower pot. Like their house, you know their address. But the agents, the agents show up at their house, they knock at the property didn't sell. I would love to be the agent that you select to sell your home. I didn't want to bother you. I wanted to leave this with you, and I'll follow up with you in a few days. For listings, you're going to have them all from the MLS. Well, I mean, then you could shoot you can shoot your own pictures outside the property. Right, right. I mean, it doesn't matter. It doesn't matter. The seller doesn't care. They care that they're going to show that you're positioning yourself better than the other agent that didn't sell their home. So I would highly suggest that you shoot some photos of your, if what you said was correct, and there's some crap. I've seen them before. Anyway, I digress. It's some of the stuff do. It makes it easy for you guys because now this is who you're competing with, right? There's a bunch of them. So this is one of them. So for first-time home buyers, there's a mortgage credit certificate. It's $2,000 per year for the life of the mortgage. So it's a $60,000 incentive being offered right now, and I can do this. It's a $2,000 per year tax credit for the life of the mortgage. $60,000. Trust me, when we talk to buyers about this, it gets them excited. So does anybody know the difference between a tax credit and a tax deduction? Do they have to? Potentially, I'll go through that one second. So a credit is a dollar for dollar deduction off on your income taxes. So for example, there are certain things as realtors, when you guys file your taxes, there are certain things that are taxed that you can do a tax credit on, which is a dollar for dollar refund of the money you spent. And there's certain things that are tax deductions that your tax bracket is, right? A tax credit is always better than a tax deduction. Would you rather have a full dollar back of the dollar you spent or 28 cents on the dollar you spent, right? So that's what a tax credit is. It's a dollar for dollar refund of money that you've spent. So the MCC program, Mortgage Credit Certificate, is a dollar for dollar refund of up to 50% of the mortgage interest each year, up to $2,000. So let me just give you a quick example. If they spend $5,000 in mortgage interest, they'll get first $5,000, which is $2,500, right? Thank you. But they only can get a maximum of $2,000. So they're going to get $2,000 of the $5,000 completely given back to them dollar for dollar. Then there's $3,000 left over, right? So they spent $5,000, they got $2,000 back. Now there's $3,000 left over. Let's say I'm just going to do it for my easy math in my head, they're in a 30% tax bracket. So they're going to get 30% of that other $3,000 back, which is $900. So now they got $2,000 plus $900, they got $2,900. Every other home buyer who has a property as a primary residence, their mortgage interest is tax deductible. So if that same buyer didn't have the MCC program, they're going to get 30% back of the $5,000, which is how much? $1,500, right? So would you rather have $2,900 a year or $1,500 a year every year? A rhetorical question. Tax refund. Yep, tax refund. Correct. Now they have to have a taxable income. You don't pay income tax in, you don't get a refund back. This on their loan though, because circumstances change, and you can only get this up front when you buy a home. So they might not be having a taxable income right now, but everyone's situations can change, and they might have to go back to work, or they might have to change. Their situation changes, and so they might not be able to take advantage of it up front if they have, if they're on a non-taxable Social Security or whatever their income might be, disability or whatever their income is. If it's not taxable, I will still put them in, because if they go back to work one day, I want them to still be able to take advantage of this credit. This is a huge win for the buyer. And it's also a huge win for us, the lender, because when I'm competing with another lender to earn their business and I'm giving them this and the other lender is not, game over. I'm going to give you back half your interest, is the other lender. And then they're going to go ask their lender about this, and the lender's going to be like, I have no idea what that is. Because most lenders have no clue what the tax credit is. Any loan. So it's just something they can get. There's income restrictions. They're pretty liberal, usually between $80,000 and $95,000 per household income restriction. It's different per county. It's also different per household size. So I don't want to bother you guys with that, but it's pretty high. It's pretty generous, between $80,000 and $95,000 per household. So a lot of households do qualify for this. Correct. And they cannot have owned a primary residence in the past 3 years. They cannot have owned a primary residence in the past 3 years. And they're going to check that from their income tax returns to see how they. I do. I can email this to you. This for a first-time home buyer. Well, this is for a first-time home buyer. Yes, this is for first-time home, but they cannot have owned a home, a primary residence. They could have owned a rental property as long as they're showing as long as they're not claiming it as a come to me and say it's a rental property, and I look at their tax return and claiming mortgage interest as a deduction. No, not just us, but very few lenders do, because all of my sales team has to go through training, all of our processors and all of our underwriters. Most lenders can care less. It doesn't benefit the lender. I don't get paid to offer this. So there's really no benefit to us to offer it other than the fact it's the right thing to do for the buyer and it earns us business. But a lot of lenders don't want to be held liable for any of the compliance surrounding all this. Plus, all their people have to go through training and be certified. Yes. Well, it's offered specifically, and it's also offered to the state. It's also offered. I can do anywhere in the state of Florida. It's a fantastic program. I'm not going to go with all the specifics of it. Could be repayable. I can tell you I've been doing this for 8 years, and I've never had one customer qualify to have to repay it, because your income has to go up by a certain percentage, as does the price of the property. And it's based on what the maximum income was at the time that they got the MCC, and their income has to grow by a certain percentage that's allowed, based on that where the income was started. So, for example, a buyer has a $50,000 income, and the income at the time was $85,000 for the qualification. They're only making $50,000. So the increases are based on the $85,000. So if their $50,000 of income would have had to grow to over $85,000 by the time they sell their property, and the price of the home has to increase by a certain amount based on the guidelines. So we give every buyer a brochure up front, which is called a recapture tax brochure. So we educate them very much so on the potential recapture. We do, 25 of these a month, and I've never had a buyer have to have to pay back a portion, and they don't ever have to write a check. It's going to be recaptured from their income taxes, so their refunds will be after 9 years. Their